was kind of a doozy.
Yeah, we had quite a week, Tom. What we always start out looking is at our calendar. It's where I begin every. One of the things that ended up happening last week is that the festivities, let's call them, started on Wednesday with our GDP report, which was a stellar GDP report. We were up at 4%, much higher than most analysts ended up predicting. There was a lot of chatter about it totally took away the first quarter's GDP report, which was negative, as everyone remembers, and that it was more weather-related and things had started to end up getting better. Later that day, the FOMC came out, so they're going to continue to end up, reducing the amount of quantitative easing that they're doing. Now, remember, they're still doing their quantitative easing, but they're on schedule. What was kind of interesting is that the market's initial reaction was positive, but they didn't seem to hold, and they sold off some more. Things get kind of ugly on Thursday. We found out that one, Argentina was put in default, at least by a Standard & Poor's, so they put in default because they had not ended up not meeting some of their debt obligations. This has been going on for a while, for people who haven't been following the story, that the Argentinian economy had been using a lot of U.S. dollars, and the official exchange rate as set by the government wasn't what was going on, if you will, in the black market or off the exchange currency rate that the government had set. And they ended up not being able to make a payment. There was a bank in Portugal that took a really big hit because they ended up owning a lot of the debt. And so there was a lot of pre-market selling. One of the interesting things was that I ended up seeing was the employment cost index. While our jobless claims, and everybody looked at the jobless claims, and they were pretty good, one of the things that we had seen in the employment cost index that there was a lot of discussion on Thursday is that it was higher than expected, both quarter over quarter, year over year. And if unemployment is still, in the above 6 area, and our participation rate is so low that unemployment's much, much higher, there seems to be a disconnect between that. Then why are companies having to pay more money to hire workers? And there was a lot of the things that I had read throughout the week, but it basically comes down to, because of the economic situation, older skills, much higher percentage of people who are on disability now than were, several years ago. That there were so many, as they call them, discouraged workers, that there's not the skill set that the companies end up needing. So there's this greater disconnect. And what this ended up showing was that companies are actually doing much better than maybe the unemployment numbers or some of the other economic data would end up showing. Again, it got totally buried underneath all of the issues that were going on in Argentina and also what's going on in the Gaza Strip with the Palestinians and the Israelis having their conflicts. These things can end up getting much, much worse if they continue to persist. But if we go and we take a look at, like for example, the history of Argentina, and we took a look, Tom and I were just talking beforehand about their previous debt issues that they've ended up having. When you take a look, and this is here, I just want to be able to show you, here's a list of sovereign defaults. Argentina has had, this is their 5th issue, since I was in college, You take a look, they defaulted in 82, they had just the disaster that was happening, throughout 2002 to 2005, and now we're going through this again. So when I take a look at Argentina, is it an issue that will spread throughout the world? And it really is more confined to the country than having something like happened back in 89 and 98 with the Asian contagion, and we ended up having a major issue in terms of debt. But again, we got through that rather quickly. So Tom, we were talking a little bit about there's definitely fear. It can end up getting worse, but I see this thing probably getting worse before it gets better. But once we get through it, and does it take a month or two? By October, September, will we be through this? The answer is probably. There's going to be some volatility between now and then, though. One of the things that Tom and I were talking about during the week was what ended up happening with the VIX and the VIX futures. What you're looking at here is a 6-month chart. Go all the way back. You can see the full 6 months. But a 6-month of the VIX on the top. What we were really on over the last 2 months was these are regression channels. The white line is the center regression channel for the VIX, and you can see obviously it had been trending down for a while. This is the one standard deviation regression channel below the one standard regression channel above in terms of the yellow line. The red line is the two standard. When we ended up having problems, a few weeks ago, if you remember, the VIX was up about a little over 30% in a single day. We ended up reaching the regression channel, kind of set the regression channel from where we were, and then ended up moving. And over the last Thursday, Friday of this week, we hit the second standard deviation. The lines on the bottom is something that I had mentioned last week that I look at all the time. I like to look at VIX Central. Basically see where, if we're in backwardation angle of the first and the second month. I really like to end up looking at this, real time. We're looking at a daily chart. The green line is the second month VIX futures minus the first month futures. When we are above zero, which is the white line, we are in contained, which means that there's a drag on all of those VIX products like VXX and UVXY. There is a tailwind to help them if we get below zero. Okay, so you're looking at the second month minus the first month in the green line. The yellow line is the third month minus the second month, okay, and the red line is the fourth month minus the third. Very similar to the way the VIX Central had set it up. One of the things that they don't keep track of, which I kind of take a look at, it's a bit more volatile, there's a lot of noise in it, but the purple line is the first month VIX futures minus the cash VIX. So what ends up happening is that you end up seeing a much, much greater movement when things start in terms of the market. We can end up seeing we were down for a day, literally one day we were in backward because we're below zero in the cash VIX when we compared it, subtracted it from the VIX futures. And on Wednesday, we had sell off a little bit, but Wednesday evening was when we started to get in a lot of trouble. I also tend to look at this not just on a daily basis, but look at it for the week on a 15-minute basis. At 15-minute basis, what you can end up seeing is that, and Tom actually called me, we were actually got into backwardation at one point on Friday. And that's starting to show that the markets have, they're starting to get worried. Now, it ended up, this meaning the future backwardation, the cash will end up always moving first. People start to end up panicking, buying puts much higher. And that's something to kind of review because Tom, this week, I've actually been on vacation the second half and working remotely. But Tom, you actually made some trades during the week, okay?
Right.
And I thought it would be really good for everybody. Tell us what happened.
Okay, well, let me take the ball real quick, and I can give you a peek. Let's see, share my desktop. Okay, so, I live in Europe, so my hours are a little bit strange, but I did wake up periodically and check with my iPad in bed to see what the markets are doing, and I happened to notice that the ES futures were down $13 about, 3.5 hours before the U.S. markets opened. So I actually got to my computer and started, I bought a put debit spread for my ES futures options position. And then when the market opened, let's see if I can get interactive brokers.
Tom, are you sharing at this point? Is it just me that
I am. It's probably just kind of loading up now.
I still have the green or the blue. Yep, I got it now. Perfect.
Okay, so this is kind of the same chart that you were looking at before. This is the red is the ES futures options, which is the S&P E-minis, and the colored one is the cash VIX, and the blue, or these three lines, are the August, September, October VIX futures. So here I could see when the front month crossed the second and third month futures. Yep.
Right. I like to tell just everybody what is the other example. We were subtracting, the line, which is which is October.
Right. So on your chart,
you can see how when they combined.
Right. So just a different way to look at it, but you get the same information. You can see when the front month are higher than the back month. And here, during the day, the distance between them, for instance, collapsed quite a bit. And even towards the end of the day, they're all very, very close. So we're pretty close to going into backwardation again. But let me show you the chart for, let's see, ES futures. You go this week, and 20-minute bars ought to be enough. Okay, so now these are the futures. So this is when they're trading outside of the U.S. markets. You can see when the high volume is. That's when the U.S. markets are open. And here's where our GDP report was with the pop and the sell-off, and then the FOMC pop and the sell-off. Now, on Thursday, this is when I was checking the market right about here. It was down about 13 points. So that's when I did my first adjustment on my ES futures options broken wing butterfly, just about a put debit spread. And then when the market opened, I did an SPX trade. Let me pull up SPX. Let's see. Oh, actually, this is SPX. So this is Thursday. So right about, let's see, the market opens here. So right here is when I bought a put. I just needed to get some short, or not even short dollars, to just flatten the position. So I bought a put just, because the market was selling off and I wanted to do something right away. So I bought a put and they kept selling off, and then later on I added a put debit spread. But I bought the put early enough before the volatility had really picked up that it wasn't too expensive. But as the vol started really spiking, then it made more sense to do put debit spreads, because you're buying a lower volatility than you're selling, and it keeps the position pretty nice. So here's the position right now, and it was up at 1970 before. So as I bought the puts, I was pushing this side of the chart down, but keeping this region flat, and it's actually in pretty good shape. It's only down like I think about $1,200. These numbers aren't quite right. I had to update them from Interactive Brokers, but I'm net one long put because of that extra put. So in a portfolio margin account, if you look on here, it's actually going up. So the margin's ridiculously low in this trade. It's something like $10,000. So I'm just waiting for the volatility to kind of come out, and just trying to keep the T+0 line flat. And the put debit spreads are doing a great job.
That's really nice, Tom. One of the things that I had definitely seen was that when the volatilities pop like this, you can't buy puts, straight puts, if the volatility is popped too high. So the way that you had managed this, the initial purchase before volatility pops, there starts to be a little bit of selling pressure, but the vols aren't too high, makes perfect sense. But after that, you really do need to take a look at verticals. One of the things, because of the way, you and I have set up these trades, is that they have limited risk on the downside, meaning that we haven't sold naked puts. We've just sold put spreads.
Right.
Okay, on the downside. So therefore, once you get your adjustments done, being at least the first one, so that you're relatively controlled, using the put verticals are a very, very effective way of doing it, because you're buying the lower volatility and you're selling the higher volatility. So if there is a vol crush, if everything turns out, it's no big deal, those long puts would end up losing so much value if you ended up just buying the put. Now, conversely, if the world does start to fall apart and volatility goes up to 60, the long puts will end up making money much, much quicker than a put vertical. But
sure.
the way I set up a put vertical for protection is, and everybody has to set it up for what's right for them and their portfolio, but I like to end up buying my put verticals a little bit below the money. I put them on when the vol skews are still pretty steep before the vol gets too expensive. And you want it to be able to, depending on what you're trying to end up protecting. For myself, I was trying to protect, a significant amount of butterflies. So I was risking 1 to make 5. So I bought a 50-point wide put vertical below the money that I paid about $10.50 for. So that this way, the most I could lose was my $10 and change, and the most I would make was nearly $40. Okay. So that type of ratio is something that when you take a look at, you want to be able to try to end up focusing on, and you want to also make sure that it's appropriately sized for what you're trying to protect. Can you kind of take us through a couple of the trades and show the folks what you ended up putting on?
Yeah. So my initial, let's see, let me go back to here. Okay, so now these aren't, there's some missing strikes in between, so there's actually more distance between them. It's just easier to read it this way. My initial long put was the same long put that I had for the upper part of my position. So I was trying to keep the number of strikes in play to, not to get too out of control. But then the first put debit spreads I added were using the same strikes that the rest of the spread was doing, so it's something like this. And at the time, the market was up above it, so it was a little bit out of the money. Then as the market moved in the money, this was the last one I put on, and it's actually, the price aren't too far from where I put it on. So this is kind of what that put debit spread looked like. So I was trying to get some negative delta. It's a pretty good risk to reward ratio. I'm risking $1,000 to possibly make over 3. So it's a nice risk to reward thing if we keep moving lower. But, it's doing a really good job of just keeping the T+0 line flat over a pretty good region. But that's basically what I was doing. I was essentially buying a long put and then capping it off about, 45 points lower. So, I was getting a good hit for this put if the market kept going lower, and it was a 15.8 vol versus the 18.1 vol for the one I'm selling. So, No, overall, I thought it was a pretty good investment, and it seems to be doing a good job just, smoothing everything out.
That's really nice. It's the wider you make your put vertical, the greater difference between the buying the lower vol and the selling the higher vol. Okay.
Right.
However, the wider you make your put vertical, you'll be paying a greater and greater price in terms of theta.
Right.
So when you take a look at it, you kind of have to end up balancing out how can I get the most protection that I can while paying the least amount of theta. And that's going to end up depending a lot on the amount and level of protection that you need to end up putting on for the specific position that you're protecting.
Well, and the other thing, too, is you make it wider, you're actually adding more positive vega, so reduce the vega in the position by about 40 points. So that's another reason I wanted to go a little bit on the wider side, just to help with the vega problem.
That's a really, really good point. The ultimate way to end up getting vega is just to buy a naked long put, right? So if the market goes down, it's end up going up, it's almost a double whammy. You're making money on your deltas. Your deltas are getting stronger because your gammas are helping your deltas as you move down, and you're making money on your vegas. Buying the wider put vertical, I think, is a much better trade-off because at least you're gaining a little bit in terms of not paying as much on your theta. You're still getting a lot of your vega, not all of it, but a good chunk of it. You still end up helping your delta. Okay, not as much as a straight put, but when it does reverse, or if it does reverse during the time period that you have it on, you don't get nearly as hurt. Everybody has scars and things that they remember, but I had tried to buy puts, if you remember, after the 6 de Mayo, right, the banking crisis in Europe several years ago that happened on May 6th. And I ended up buying puts, because the market was just, it was the flash crash, and everything ended up happening right after it in terms of the European, the European Central Bank, and when the following Monday, when the central bank said, oh, it's okay, we'll end up helping Greece, we'll end up helping the governments, vols got crushed and my long puts just got destroyed. And you learn these things. Now, if you have them on and things would have gotten much worse, I would have been happier. So usually those wider put verticals tend to end up giving you a much better risk-reward ratio from a probability point of view. Doesn't help as much in a crash, but if it comes back up, you're much, much happier. I think this was a great time and lesson to be able to end up showing folks what was going on during that time, because the put verticals just really ended up neutralizing any type of a large loss that you might end up taking because of it.
Well, and really, I'm down $1,200 on this trade with a 300 vega, so really it's only a loss due to volatility. So if I took 3 or 4 points out of this position, there we are, now we're in the black. So I'm just waiting for the market to kind of stabilize and for vols to come out, and then, hopefully I'll benefit from that reduction in volatility and can close the trade out for a profit.
Right, and if the market does move back up, you can end up selling that put vertical that you ended up putting on. Yes, it'll end up being at a small loss, but you were able to end up keeping the trade on and not end up sustaining a large loss during a period where, quite frankly, I'm sure a lot of people got hurt a lot worse.
Right.
On Thursday and Friday than this.
Well, and I was even thinking, I'm only down $1,200, and there's still 29 days to go. So I could just reposition the whole thing, just take it all off and start over again. That's one nice thing about keeping your losses under control. You can do that kind of stuff and recover.
Great. Looking into the next week, Tom, what do you end up seeing? What's your plan in terms of being able to end up continuing to end up managing the the uncertainty that we're seeming to have here?
Well, I mean, really just trying to keep the T+0 line under control. You know, I'm using the futures too. I actually made $300 on a futures trade on Friday morning. But I'm not afraid to take risk, and especially with the markets being so nervous, you know, I don't want to wait to make adjustments to the downside. So any chance that I see that the market's starting to sell off more, I'll be aggressive at defending it and getting more short delta. Now, there's not really a lot of economic news coming out for the first part of next week, so I don't anticipate that there's going to be a lot of events that are going to move the market. You know, obviously we could always have some news that's unexpected, but hopefully we'll just kind of stabilize a bit here and consolidate, and, you know, volatility maybe come out a little bit. That's what I'm hoping.
Yeah, I think that's a good point, because we're kind of, there's not a lot of things going on economic-wise, and because of that, the news cycles will be focused a lot more on what's happening in Argentina, what's happening, with the Israeli conflict. You know, we didn't think with Russia and the relations, as that gets through, well, there are Russia and their involvement, that will end up dying a nice slow death. The one thing did come up about that during the week was that it doesn't appear that the economic sanctions that different groups were trying to put in place are going to end up quite the effect that they wanted to, because the only thing you can really sanction was their oil and their natural gas. And as you know, Tom, living in Germany, Western Europe gets a good chunk of their energy, and their natural gas, from Russia.
Yep.
So that would almost be like mutual destruction. Unless it ends up escalating, which it can, but unless it ends up escalating again and gets much worse, we're going to see that kind of fade away. So it's really a watch and wait and see market that we're in right now. One of the things that I had mentioned to you, next week, we're not going to be in the same place, right? Either things will start to end up getting better, or if they do get worse, we're going to see the events and things occur during the week that things are going to get much worse. If they do, there shouldn't be a long-lasting effect, but for what's the easiest way? Put the money on the sideline, wait, come back in September, see how things are. But that's not how you end up getting experience, right? The way you get experience is actually trading through these things. It is a great opportunity, I think, in terms of learning.
Absolutely. And, one mistake I made when I was learning to trade options is it took me forever to actually start live trading. I was so focused on trying to, get my paper trading down perfectly that it took too long, and I tell people too, some guy wrote me the other day and said he was going to spend half a year to a year paper trading. It's like, oh, that's good, but also do one or two lots in live trades, because they're totally different, and you really need to put your feet in the water, as Dan used to say.
Yeah, you do. It's amazing, because it's the way people end up reacting when they have their money on the line versus if they're just trying to do it as a purely intellectual exercise is very, very different. So I think that's great advice. Anything else you wanted to end up sharing?
I think that's it. We don't want to take up our viewers' time too much, so. Jim, enjoy your vacation. Hopefully the weather's nice.
Thank you very much. We're up in Cape Cod, and we'll see. So everybody take care, and we'll talk to you next week.
All right, great. Thanks a lot, Jim.
Okay, bye-bye.
Bye-bye.